Hey everyone, Shopify stock was up 124% in 2023. But is Shopify stock a buy for 2024? That's the question I'm going to answer in this video, reviewing the company's latest financial metrics, investor strategy from management, its expectations for the next couple of years, and weighing it against its valuation and total addressable market opportunity. After all that, I'll answer whether or not I think Shopify stock is a buy for 2024. So let's get right into this financial analysis.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
Before we look at Shopify's revenue, let's consider the total addressable market for e-commerce. According to Statista, the total e-commerce spending in the United States came in at over $1 trillion in 2022. That figure is estimated to grow to nearly 1.5 trillion by 2027. Surprisingly, in 2022, when total spending was over $1 trillion, it represented just 14.6% of total sales. Total retail sales surpassed 7 trillion in 2022. Of course, e-commerce is more convenient than shopping in person. It's understandable that the industry will grow to a larger share of overall spending in the next several years. In fact, the industry will likely continue to expand beyond 2027. Don't get me wrong, e-commerce sales will never be 100% of the total, but it wouldn't surprise me if it grew to be larger than 50% by 2040. Now, several companies will benefit from this trend like Amazon, Shopify, Etsy, and eBay to name a few. Even financial transaction facilitators like Visa, MasterCard, and PayPal will capitalize from a greater percentage of shopping happening in forms where cash payments are not an option. That being said, you can see Shopify has grown revenue very nicely in the last decade, all the way up to $6.651 billion. But as I mentioned with the total addressable market opportunity, you can see Shopify still has a long runway for growth ahead. Shopify's operating profit margin was growing very nicely over the last decade. That is until this point here. You can see this drawdown. What troubled me about this drawdown in Shopify's operating profit margin was that it was a self-inflicted wound. Shopify had been running up until this point an asset-light business model. Then it decided to invest billions in dollars of offering merchants logistics services. Shopify wanted to get into the shipping and handling and warehousing of goods. Now, as you might imagine, that was an expensive proposition. They wanted to spend, and they did spend billions of dollars. They made a $2 billion acquisition, and that started to eat away at the company's profitability. Now, when they announced that move, I highlighted that I was not a fan of the stock. Before they announced the move, I had Shopify stock rated as a buy, but as soon as they announced that acquisition and they signaled that they're getting deeper into shipping and handling and logistics, I pulled out and I said, I'm not recommending Shopify stock anymore. Now, the reason why I did that is because the logistics, the warehousing business has proven to be expensive. It will cost billions of dollars to build out, and they come with lower profit margins. You can compare with companies like Amazon, and you can see its e-commerce segment that handles a lot of logistics and warehousing, very low profit margin. And you're competing against Amazon, who is arguably the best in the business. So for those reasons, I didn't like that strategic move from Shopify, and it turns out that it was not fruitful. Their profit margins collapsed, and management ultimately decided to divest that business. They said, you know what? We agree it wasn't a good idea, and we're not going to do it anymore. So they sold that business, that part of the business off. Still, I'm hesitant to give management the benefit of the doubt here following a mistake of that magnitude. So I'm still holding Shopify management in sort of the penalty box area where they need to now prove some strategic decisions that are prudent and effective before I can give them that benefit of the doubt and say, okay, this team is going to do a good job managing this business. For now, I'm a little bit hesitant and worrisome about the effectiveness of this management team. Still, the company's recovering now from that decision to invest in the shipping and handling, and you can see its cash flow from operations bouncing back, similar to what's happening with the operating profit margin. It's recovering now that it's divesting away from that business, but it's got a ways to go before it recovers back to its peak level, 8.92% in the most recent trailing 12 months. Now, the company will benefit from that tailwind of the rising total addressable market for e-commerce and the convenience online offers, and the fact that merchants prefer Shopify's website because it gives them more control over their customer relationship management versus something like selling on Amazon. Still, the company does need to demonstrate effective execution of the business plan so that it can increase its profitability. Right now, it's still narrow, and if you look back, choppy, right? It increased and fell down, increased again, of course, during the pandemic because of the boom in online sales, and then crashed because of that decision and the economic reopening, and now recovering. So I don't see a clear trend upward here for Shopify, which I'm being a little bit picky about Shopify's performance, and you're going to see why when I get to valuation. I'm a little bit more picky about companies that have such an expensive valuation than I normally would be if I was looking at a cheap stock. If I'm looking at a cheap stock, I'm willing to overlook some undesirable characteristics because it's so cheap, right? But when it's super expensive, I want all of these metrics to be top notch if I'm going to pay a premium valuation. Shopify's balance sheet is in solid shape. They've got $4.918 billion in cash and short-term investments, and they've got $915 million in total long-term debt. They also own a percentage of the logistics business that they sold. They didn't sell it for all cash. They sold for cash and they took back some share of the business that they sold. So they're still going to reap some of the benefits of the investments of the logistics business, although they've sold it off and it's going to be managed by another entity and they will own a percentage of that entity. So they will receive some of the benefits of that sale and of that business. Shopify's price to sales ratio. The price to sales ratio measures what you are getting for the price you are paying in terms of sales. So what are you getting for every dollar in sales that you're paying? For example, in this first example, the market capitalization is $1.25 billion and the sales for the previous 12 months were $185 million. That means you're paying a price to sales of 6.76. Similarly, if you look at the expected next year revenue, you would be paying $1.25 billion for $465 million in revenue expected, and that would mean the forward price to sales ratio is 2.69. The factors that influence the price to sales ratio include profitability. Of course, you would be willing to pay a higher price for a company that generates higher profits. That means $100 in sales will turn into $20 in net income for a company that has a 20% net profit margin. That same $100 in sales will only turn into $5 in net income for a company that has a 5% net profit margin. So companies with higher net profit margins tend to sell for higher price to sales ratios, all else being equal. Another thing that influences the price to sales ratio are growth rate expectations. All else being equal, companies that are expected to grow at a faster rate sell for higher price to sales ratios. Similarly, higher total addressable market opportunities tend to result in higher price to sales ratio because investors see this company being able to grow for a longer period of time before hitting the ceiling. And finally, cyclicality. Companies that are more stable and less cyclical tend to sell for a higher price to sales ratio because cyclical companies are seen as being more risky. Companies like McDonald's are seen as being non-cyclical. McDonald's does relatively well whether the economy is booming or whether the economy is in recession. And so investors would be willing to pay higher price to sales ratios for companies that are less cyclical. Investors use the price to sales ratio when a company has negative earnings, unstable earnings that fluctuate between positive and negative, and also the same for cash flow. If a company has negative cash flow or cash flow that's fluctuating from positive to negative, the price to free cash flow and price to earnings ratio are less informative, so analysts use the price to sales ratio. That being said, you can see Shopify is trading at a forward price to sales of 10.34. That is a relatively expensive valuation, even though it's down from its peak of over 30. Now, I mentioned that when I'm looking at a stock that's this expensive, I want everything to be near excellent when I'm paying this valuation for a stock, and that's not really the case for Shopify. They've got some undesirable characteristics. They're still recovering from the decision to invest in the logistics business. So all that being considered, if I was to say if Shopify stock is a buy for 2024, I would say no. I would say it's a hold. I would say I don't think it's something that you should panic and sell. It's not that bad, but it's not in a position where I would recommend buying Shopify stock. I'm still on a wait and see approach for Shopify going into 2024. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button, and I'll see you again soon.